All right, what's going on, everybody? TGIF, right? We made it all the way to Friday. I feel a little bit like it's a tinfoil hat, but all week was trying to figure out why the market was going sideways. And a lot of people said, well, we're probably waiting on CPI for Wednesday. And on Monday and Tuesday, I didn't want to say that because I really didn't think it was CPI. So then we got to Wednesday, and I told everybody I really don't think it's CPI. I don't, but maybe it is, right? Maybe. And we made it through CPI. We made it through the 10-year, the 30-year. We still went sideways. Still went sideways. Been seeing a lot of posts this afternoon that the attack from Israel was telegraphed and that everybody knew it was coming. And if you put those two pieces together, everybody knew it was coming and the market went sideways. The market was waiting for the hit, right? And look at the reaction in the market. Sure, we went down. Yes, but not by a lot. The market didn't freak out. We didn't really get one time framing, and we've already started working our way back up again. This isn't a scared market. They're not running for the hills, reacting, as if it was shock and awe, because it wasn't. It is very likely that the range that we had most of the week was because of the pending attack from Israel. Tinfoil hat, maybe, right? Maybe it's all conspiracy. Who knows? I don't know. Somebody smarter than me knows somewhere. So what's up with y'all? Anything good? I mean, somebody tell me something good. We had a request for cumulative delta discussion. This ties in if you're day trading mostly. I really don't know how you would want to tie it into a swing trade perspective, really. And I've gone through this material before, so it's not necessarily new and it's not earth shattering either. I mean, it's good to know, but it's we've certainly reviewed this stuff before. So if you guys see something or you want to talk about something, through the day today, just hit me up. Otherwise, let's do a little review on cumulative delta. And I want to start with the insight of cumulative delta. And then I want to point out that it's very specific for who you use, right? And I was just talking to somebody about this because I've been sharing pictures in the chat of cumulative delta, and they were saying how theirs looked really different than mine. And I had a sneaky suspicion that they were using TradingView, and they were. So if you're using TradingView and it has cumulative delta now, which is cool. I mean, I'm glad they have it. The the one on TradingView makes assumptions and is not looking at the real bid and the real ask. So that's the main issue. So cumulative delta in its simplest form is a comparison or a measurement between buy orders and sell orders. Now, I simplified that a lot, and I can certainly give you the nerded out version. But at the end of the day, we're just looking at how many buy orders did we have versus how many sell orders. And I think what confuses people is the fact that in the trading world, we all know you can't have a transaction unless you have both parties, right? You have to have a buyer for every seller, or vice versa. You have to have a seller for every buyer. Otherwise, you can't get a transaction. So, if that's true, how can we have more buyers than sellers, or how can we have more sellers than buyers, right? You can't. So, I think that's where most people get stuck when they try to use cumulative delta because I had just mentioned it's looking at how many buyers we have versus how many sellers at the same time that we know we can never have more buyers than sellers or more sellers than buyers. So the disconnect is how the trade was taking place. If the trade was just resting on the dome, then cumulative delta doesn't record that because that's passive order flow. At least real cumulative delta doesn't record that. And that's the distinction that I'm going to have to keep making through the day today, that there is cumulative delta, the real version, and then there's cumulative delta, the TradingView version. And I'm not picking on TradingView because it's not just TradingView. There are other platforms out there that offer, quote, cumulative delta. I've got a homemade indicator for Thinkorswim, and it does the same thing that TradingView does, basically. It's not looking at the bid and the ask. It is simply looking at the uh, the way the candles closed. So with a real platforms like Jigsaw or Bookmap, when we look at cumulative delta, it's looking at trades that hit on the ask or above, or trades that hit at the bid and below. I've had new traders tell me, "Hey, man, that's kind of confusing," and I get it. So let's simplify it a little bit more. Cumulative delta is market orders. And if you think of it just like that, even though technically that's not true, but let's just say cumulative delta is only market orders, and it's how many market orders for a buy versus how many market orders for a sell. And that doesn't cover any contracts that might have been resting on the dome because those are not market orders. Those are limit orders. They're just resting there. And when we do it that way, we can start to define who's in control. So in the lower part of this chart, I've got cumulative delta, and in the upper part, I've got the ES. And we can see that cumulative delta is headed down because there are more people hitting sell market order than there are people hitting buy market order. It is as simple as that. So if we just remove all of the complicated language and the fancy phrases, we can simply try to look at it from that point of view. How many market orders of one versus the other? Now, we can get a lot more in depth, especially when it comes to how to use it. We can also get more in depth when it comes to how we want to visualize it. We're looking at cumulative delta, but there is just delta, and that's for every single candle. What was the delta in that candle? Kind of like volume. We can look at cumulative volume all day long and see it tallied up, but we can also just look at overall candle volume. What did this one candle's volume look like compared to the one before or the one after? So we can run delta in multiple ways. Cumulative delta gives us insight on where we're going on the day. And you can see, maybe you can see, because stuff's not easy to see in the streams, that there's a zero line right here. And we just fell down and broke below the zero line. So we had throughout the day in aggregate more buyers than sellers, and we were above the zero line. And now we're losing it and we're headed back down and we are crossing below into more sellers than buyers. And what's interesting on that is if you look at where we crossed above, it was back here. So at that part of the day, We were at 59.90 when we went into positive delta on the day. We just went into negative delta and we're at 6,000. We lost something along the way, yeah? At the end of the day, knowing what it is part of it. Knowing how we can use it to make money is something completely different. Earlier, we had a really nice trade setup. It gave us an early warning because cumulative delta broke down before price did. Seeing if I can find that breakdown. Yeah, it was right there. So let's just zoom into that spot. So right here, we had price rising and it had not yet broke down while we had the CD starting to roll over and it did break down. So price had to run over and get caught up and it gave us a short. I put it in the chat as it was breaking down that hey, CD broke down before price did. And it was a nice heads up. It gave us a short play. And then just right here before I started streaming, we had divergence again, right? Right here. We broke into a new low here in price, but CD did not break down into new lows here, right? So we had the same low on CD at this spot that we did back here, but price broke lower. So price was giving us a fake out, like we were going to go short from here. And CD was saying, nope, don't have that. It doesn't mean that we wasn't going to go down, but it was warning us, that that short wasn't a very good short. So now, you zoom into smaller and smaller and smaller time frames, this can get more and more agitated. So, it can get really bad. And if you're zoomed out really far, then, I mean, you may as well be on a daily at that point. What we've been looking at is a candle chart with cumulative delta underneath it. That's pretty obvious. But I'm going to activate my dome with its delta now. So just spread this out a little bit and we'll put the dome on. The dome. What you going to do this weekend, homie? Yeah, yeah. Right on. I am always happy to be somebody's excuse. So one thing about Bookmap versus Jigsaw is that when you turn on Jigsaw, you get your price action from the moment you activated it. And since I just turned on the chart portion of my dome, we don't have any price action showing before I hit the button. So we got to let Delta kind of play out a little bit. I scrunched up the price action so that we have Delta showing in the bottom part here. And as you can see, it's much more zoomed in, right? Way more than the candles that we were looking at on that tick chart a few moments ago. And I can zoom it in even more. That's not really an issue. It's just the idea that, you know, when it comes to looking at things from a smaller and smaller and smaller perspective, we can always, put it into a smaller time frame, but that doesn't necessarily make it better or give you actionable trade logic, right? Some yeah, they really each have nice features. At the end of the day, I didn't like getting nickel and dimed for every single thing with Bookmap. It seemed like every time I turned around, it was no, you got to buy this, you got to buy that, you got to subscribe to this. Oh, and you have to have that over there, and it was frustrating. With Jigsaw, I made one payment. I own it for life. I didn't feel like I needed to hurry up and begin using it right away to get my money's worth because I knew I owned it for the rest of my life. With Bookmap too, it seemed like I had to get data feeds for everything and that every one of them was a different data cost. That's much better. That is much better. Yeah, I mean, well, I like that Jigsaw has regular charts. So in the mornings when I use it, a lot of times I won't turn on any other charts. I'll just have my Jigsaw up because it has charts and then it has the dome and all of this. One of the things about the book map is I took their color scheme and I made all of my charts look like this. That's why my trading view looks like this, my thinkorswim looks like this, just for the uniformity of everything. And when it comes to the dome, they listened to user feedback. And now, when you start it every day, you get the yesterday's high, yesterday's low. You get all that stuff plotted on the dome, which is really nice, right? I'm not seeing it because I don't have the settings on this dome, but on my other computer, because I use two computers, if I start my Jigsaw on that one, which I usually do, it has yesterday's high, yesterday's low, Globex high, low, all already written on the dome, and that's nice. Yes. Yep. Absolutely. That's another thing I like about it. I like that, and that's what I was mentioning. Users like me reached out and said, "Why do I have to populate yesterday's high and low every day? You need to do that just as a standard feature, right? Like it's common sense. I shouldn't have to populate where the open is, right? If I'm using a TPO chart, it shows me where the open is. Why can't the comment field just start every day with those levels in it? I can add my own pivots on the side, but you know, at least give us the basic pivots every day." And they did that. And so now every day you get those. It doesn't have my cog lines and that sort of stuff, but can't expect them to have proprietary pivots that they don't even understand. So So the main thing is if you're not using one of the big dogs like Bookmap or Jigsaw, and you're instead using TradingView or Thinkorswim, and you're looking at something called cumulative delta, make sure it really is what you think it is, especially with Thinkorswim. Any Joe Schmo can make an indicator and put whatever title they want on that indicator. So I've created a cumulative delta indicator for Thinkorswim, but it can't see the bid and the ask. So it's not as good as having Jigsaw or Bookmap. It's better than nothing for sure, but it's still, it's not the same. And the big one that I hear most people ask about is TradingView. Yep. I guess somebody wanted to chime in with a news headline. The I just put some posts in the chat. One is the website for TradingView's cumulative delta article, and one is a picture showing where they start talking about the calculation. You have to understand how TradingView is calculating it if you're going to use it. The main thing being it since it's not looking at the real bid and the real ask, it's looking at candles that are smaller than your time frame. So if you're on a 5 minute, it can see the 4, 3, 2, 1, and it can see the seconds based charts below your time frame. But it can't see the real bid and the real ask. It's going to make assumptions. If the 4 minute candle closed red, it's going to say, well, that was uh, negative delta. And if it closed green, well, that was positive delta. That's a big assumption, right? So, you know, be mindful of the tool that you're using. And one thing that I always encourage people to do when it comes to cumulative delta is if you are using it on Thinkorswim or TradingView, look at multiple time frames. Don't just use it on one, because if you can see positive delta on a 1 minute, a 5 minute, a 15 minute, and they're all showing you a positive delta, you should be more confident that you actually have a positive delta. And if you go to all three and you see discrepancies between all three of them, then you know that you've got a bit of a heads up or a warning that you should proceed with caution, and and then maybe you don't get hurt so bad. So, just kind of keep that in mind. It can save you from getting hurt if you just look at multiple time frames and try to find commonality between them. So here's the CD on TradingView. I'm on a 1 minute, so it can only see the second based charts below where we're at. That doesn't make it worthless. It's just not as good, right? If I'm watching this and I see the cumulative delta start to break down here, breaks this low, before price breaks that low, I'm pretty confident in that short. And it doesn't mean, that I won't lose, because it can still happen. But I would be more confident that we're going to break this low if I see CD breaking down, especially if it breaks down looking like that kind of breakdown. That was a really nice breakdown right there. So if it's just, these tiny little bars gradually going down, that would be one thing. But if it's a big bar breakdown, I'm going to be more confident in a short. That's a easy one to spot. You can see how price here is trying to break down and the CD is not joining in on that. So we could still break down in price, but I would be less inclined to participate in that short because I'm not getting confirmation in the cumulative delta. So, again, we're just on a 1 minute, but if you can look at multiple time frames, it'll help just to kind of give you, a little bit of insight on what's going on out there. I know that there's traders who will focus on absorption and that sort of stuff. You can't really do that with TradingView. And I mean, I can do a long blog post on it, but it's going to take some time to write it up. Um, since you don't have the real bid and the real ask here, you really can't do absorption type analysis with this. You'd have to use Bookmap or Jigsaw. Now, having said that, if you are really comfortable with like TPO charts and you want to have the cumulative delta on, you could maybe kind of get close, right? Um, but you'd have to have a real skill level with it, like really understand what you're doing to begin with. Look at that breakdown. Price definitely took the run, and then CD was late to the game. It's going now, but this was one of those times where Price went first and CD is playing catch up to the backside of it. When this happens, a lot of time it's more news based than something else. It wasn't like they were plotting ahead and working on absorption and maybe we should have just stayed on Jigsaw. It probably had a more accurate CD. Yeah, CD broke here when Price didn't and was already pointing to the downside before Price did. So, yeah, you get what you pay for, right? At the bare minimum, you at least wouldn't have gotten hurt because TradingView didn't catch the signal in advance, but it didn't tell you to go long. So there is that, I suppose. So not much to it. The request was simple. It was just a discussion about cumulative delta, what it is, and how we can use it, and then the various tools that are out there for it. I don't use it all day, every day. If we're trending really well, I have no use for it, right? And that's pretty much with Jigsaw. If it's a good, clean trend day, I don't bother to turn it on. Or if it's really solid range days, I might turn it on to confirm the reversals on the edges. But really, its sweetest value to me is the choppy, sloppy sideways days. Sideways days are not range days; those are two different things. And a sideways day for me is where this thing really excels because it helps you see inside all of those sloppy candles and get a better idea of what the behind the scenes activity is. If you're trading in really tight candle ranges intraday or want the opportunity to trade at any point in the day, then having something like Bookmap or Jigsaw will really help you out. Because with these tools, there is no such thing as, it's choppy, sideways, nasty. You can get into such a small time frame here and still have structure. That's what these solid white bars are. You'll still have structure around you that you can trade any time frame, 9:30 open, 5 minutes before the close, 8:30 economic events. There's really nothing that you can't trade with it. I don't trade those things, but you know, with this you could. Look at that reversal. We came down there and hit that. And I bet we didn't absorb it. I bet some of we didn't. I bet we didn't absorb it all. I bet some of that just got the heck out of the way. But I don't see where it went if we did knock it out of the way. maybe down here. It wasn't there before. So if we're going to get lower than, I mean, we're already lower than I had called earlier. 59.92 was my next level, and we're already there. So now let's break this Globex low. Actually, that's like RTH low, isn't it? Yeah, it's Globex. Break that, and then we'll focus on the overnight lows. Very nice. Low a day. Let me get this thing turned around, and we will plot the low of day levels. It ain't waiting on me. We got the 111 and the 1236 down there, 59.64. I'm a little sweet on the 64 number. That used to be a valid cog line back in the day. It may be one now, but I never validate it, right? Like it takes weeks and weeks to validate cog lines, and I don't do it anymore. So I don't want to spend all day on this either because I mean there's not enough to spend on it other than actually just using it, and evaluating price as it comes in, which is fine, I suppose. It does help for people to see it being used live, but that's more of just a function of getting used to it. So instead, if you guys don't have anything that you particularly want to hit on, I'd say let's take a look around at the tools that we have at our disposal and see what the market has to think about what's happened this week, right? Because we've got some big picture tools that we can use to define, the market backdrop, like the macro concept. It's a nice breakdown. 59.71, it's the liquidity zone. If we're going to hold this breakdown and come back in, it would very likely happen at that 111. If it doesn't, and we continue to go to the downside, then we'll look for an opposite candle color at 59.65. If you haven't heard that phrase before, opposite candle color, and you're wondering why I say it that way, it's because if it's not bullish, and I've had people say, don't you just mean that we're going to V bottom and go back up, or don't you mean bullish? Or no, I mean, we're expecting to see another candle's color. In this situation, since we're going down, we would expect to see a green candle or a doji. It doesn't necessarily have to close green, it can just close doji. So when we get to 1236, we would expect it to get a candle close, get a new one open, that one to turn green or a doji, and then we close green or doji at the end of it. If we do, then we would move the drawing and we would have new levels even lower than this. And if we don't, if we get there and we just run right through it and we stay red and we continue to fall, I don't update the drawings yet. I just leave it the way it is. Sometimes if we do break down like that, I will turn on the 1.5 just to see, like, well, what's next? But I won't update my drawing until I do finally get that next color. So if we look at what happened on this tick chart, you can see how we got there and then we checked it and we moved back up. On the 5 minute, you really don't see that, right? You just see the wick. We tagged it and bounced back up, closed off of it. But whoa, those are some big onions. Did you get those locally? Nice. We're having salad for dinner. It's hot out. Salad just sounds good. Not with my fresh cucumbers though, because they're not grown yet. Now we're getting that breakdown, new low. And when we get to that 59.65, we're going to look for the opposite candle color to occur. So we get an OCD or an OCC. And once that candle closes, we'll update the drawing and we'll have new levels lower from there. There's been times where I've wanted to get ahead of it all and I just moved the drawing in advance. It was like, right, what was it, 60, 64? Like that. And now I can see what the next levels would be even ahead of the game. That helps you if you want to draw out what is likely to happen, right? So, we could draw out, we think it's going to get there, and then it bounces back into a 786, then it works down into a 111, maybe gets down into the 1236, then we would have to update the drawings again, right? We just on and on and on. You can really get ahead of the game knowing where the next level is going to be before we even get there. But I'm going to put it back where it was. So we have the 111. So let's look at what's going on out there and we'll just let this thing cook, right? We'll let it do whatever it is doing. This is the Mag 7 group, or the Fangs, if you want to call them that. It's a collective homemade tool. You don't need this, right? You can just bring up your regular everyday candle chart and look at the MAGS ETF. It's close enough. It's fine. You don't need it. So if you have it, great, cool. We are back above the year-to-date anchored VWAP, which puts us in a bullish bias, and we've been above that since like the second week of May. A tight consolidation period after we did get above it, and then we broke out of that, and we were holding it. See if we are still holding it. I'm not sure. Yeah, we're still holding it. So I'm coming off of this high here, right? And that's what I'm tracking to see. We haven't broke down through there yet. So as far as the Mag 7 is concerned, they are still strong. They're still holding this breakout point. And if you look at them on the weekly, they do not look weak at all when it comes to, what's the Mag 7 doing? They're still solid. As you can see, if things were going bad, oh, they can go bad really fast. Don't let this ratio chart make you think otherwise. This is silver, not so. This is growth versus value. And the one on the left, we use for the Mag 7 hyperscalers, those guys, the NY Fang. And on the right is what I generally use for just your more generically speaking growth versus value. They're both growth versus value, but the one on the left really does help trade the Mag 7 group. And it looks like we're failing on the breakout, or if we haven't failed it, we're really close to it. And if you got to zoom in this close, then it's really close to it. Yeah, we haven't done it yet, but man, it's just about there. So that 2.13 is the breakout that we need to hold. Just like back here, the 2.5 was the starting point for the longs on that play. All the Apple, Amazon, Meta, Facebook, Google, blah, blah, blah. That play. So if we lose this, all that starts to get called into question, and we are starting to get, like an inverse TRB or a rounded reversal. So long in the Mag 7 is getting called into question. We do have a issue of concern, but it hasn't broke yet, and the day isn't done. If we look at the other one, though, we started to break down quite significantly on the 6th, and it's just been a downhill trip back to the lows, and it broke that. Now we're underneath my trend line. It's not good. Both of these are above the year-to-date anchored VWAP, showing that the market still has strength in the backdrop. Where's that war showing here? It's not. Where's all the discussion about, increased unemployment and rising inflation and rising costs? And we don't see that either. So for all of the people out there chipping teeth and the bobbing heads on TV talking about how bad it is, and you couldn't tell looking at what's happening in the market because it's just continuing to drive. This chart, I generally use it with the watch list so that I can jump into individuals. I have it listed as crude, but I'll go from crude to gold to dollar to yields. It's not a ratio chart, it's just a chart that I have because I check these every day. I go through this tab list every morning, and then throughout the day, I cycle through them. So oil had that big spike up. Everybody that I know was looking at this as a sell the rip opportunity in oil. But with gold, it was a little more tricky because gold already has been in a really good bullish move. And then, of course, you get war vibes and gold becomes a long, but gold already was a long. So then gold became this concern that maybe we were going to outrun the mean and have to mean revert and get overextended and overbought. We didn't really get that, which is nice. I didn't want to see gold get outstretched like that. Last time we did, we had a heck of a sell off. So, that was the concern. But we're fine. It didn't really outrun things too much at all. Look at the blue line because that's the mean. And look at how far we had gotten away from the mean last time. That was a wide drop, long ways off. We're barely away from the mean at all. So gold has not gotten to the point where it's overbought, overextended, due for any sort of mean reversion or pullback. That has nothing to do with whether or not we might hit resistance or, top out or fall down for some other reason, but at least it won't be because of mean reversion. The indicator down below here is not lining up, by the way. We would be expecting things like matching highs, lower lows. And one thing that really stood out to me was this run here in gold and how we didn't even get a bump on that indicator. It just kept on falling. Then on that bump, we finally had a little bitty one here, just really little. So, you know, gold's just kind of doing its own thing. But all told, it's not overbought, overstretched, and it doesn't owe us any sort of mean reversion from this spot. Silver, on the other hand, was in that really beautiful squeeze and then it broke out. Nice, got way extended really fast, and then it paused and it's giving the 10 time to catch up. So we're correcting sideways now. This is what we call a correction in time, giving the 10 time to heal. And we can shorten this wait if we want to. If we just drop down and tag it, we'll be good. Kind of get a reset. Or we wait here, let the 10 get to us, and then we can continue on. And this is the one, right? We've all been waiting for this silver move like forever, and we finally got it. So maybe it's going to need to digest it a little bit. We could drop all the way back and test this previous high around that $32 level that was critical forever. But we don't want to get that gap closed, right? Look, that was a really bullish gap up too. And we were talking about the bullish gap up in Microsoft last week, or maybe it was just earlier this week. Anyways, when you have a big weekly gap up or a monthly gap up like we have on Microsoft, it's a big deal. It's crazy bullish, a weekly or a monthly gap up. Now, generally, we wouldn't want those at the highs. We'd rather have them at the lows, but beggars can't be choosers, I guess is the phrase. Either way, this gap is amazing, and we don't want to lose that. The concern is here on the weekly is we are even more away from the 10 than we were on the daily. And that 10 week, the 10 days a nice mean, but the 10 week is the real mean, right? This is the real boss. So we don't want to get too extended from that. And unfortunately, we have. So we might need to come back down, digest 32, maybe even 31 and a half, and kind of get our bearings. But we own this breakout. And that gap, I think, is what paid for it. What's going on with the markets? Let's peek. Sure, we're not missing anything. Whoa. Yeah, no. That sell-off should continue really nicely. Yeah, yeah. That's just nasty. All right, so we only made it down to the 111. We did not continue lower into the 1236, and now we're back above 1.0. So um, this, if we stay above one, we go for the 786. If we drop back below the one, we go for the 111 and the 1236. If this candle closes green and the next one opens and breaks this candle's high, I would buy it and run it back up to 59.92 cog line, that 786 level. But if this candle closes underneath that white line and the new and below the 50% of the current candle's width, I would play it as a short and take it down to the 1236. Simple, simple. Look at it on the tick charts. Is that a baby head and inverse baby head and shoulders? Oh, it's so sweet. There's your left shoulder, there's the head, there's the right shoulder, there's the neckline break and failure to accelerate. My scribbles are nasty. So I ain't going anywhere. Back to business. All right, so Bitcoin, I know it seems a little weird, to use Bitcoin for a macro backdrop, but it is a really good signal of liquidity and risk. And if they're not willing to run this, then they're not risky, right? And or they're wanting to reduce their risk, their exposure, and we want to recognize that. So we can see that it failed to get that new high. It didn't even get a matching high, but we did break this little micro trend here. So we'll call that the high. That's a lower high, lower high. We had a low, but not a lower low, right? And then here we got a lower low, and then we broke this level. So that kind of screwed everything up. And if you're wondering what the heck we're talking about now, well, that's a complex topping pattern, but it is still a topping pattern. It's not a continuation pattern at this point, and it's certainly not a downtrend because it broke that level and it came back up, but it didn't break this level. So we have a complex topping pattern on a daily time frame. It is part of a TRB setup, but it failed to make it back to that previous high. And even if it had, it only owed us that. A TRB doesn't owe us a breakout of the previous high. It doesn't owe us more. So right now, what we want to watch is this low and this low. We don't know at this point. One, we don't know how that candle's going to close. It could close, up here and form that hammer like it is. And the next one, could open and we could go up from here. And that would make this a higher low from this one. But we don't know that, right? All we know is that this one broke that and that we need to watch this low. So today's candle needs to close and we need more candles after that. If we continue to go down, we need to set a new low and get a lower low. Otherwise, if we can't break that, we got to break this. It's either or, one side or the other. And this is back to like GTFO. Get out of the box. And this is now the box. If we break this low, we end up with a lower low. And if we break that high, we end up with a higher high. One or the other. It doesn't have to be any more complicated than that. Put it on a higher time frame, and you can see that we're just kind of stalled out here waiting. And we're still above the 10 week. So we're still strong. We're still bullish. We're still healthy. Whatever word you want to put in there, we're still good. were Skittles or, you know, Butterfingers cookies. I like cookies. And we're not really overextended from the 10 week at all. So, from that point of view, it doesn't owe us a mean reversion at this point or anything like that. All right. This one's a little complicated. We'll turn that one off and that one off. On the, well, I guess I didn't need to, I can just hide that. On the middle here is US 30 by JP 30. This matches the market really well, like the S&P. I guess you could do the NASDAQ, but either one. It matches the market really well. And when it doesn't, it tells us that whatever's happening to the market is not based on treasuries and FX markets. Because sometimes it is, sometimes it ain't, right? Sometimes it's like 0 day flows or headlines or something else. So I look at this every day. I don't stare at it all day because I'm not trying to play that game. But if it's bullish or if it's bearish, if we're hitting resistance in this or breaking down through support levels, then I pay attention to it. Trend lines work really well here, and trend line breakovers, that sort of stuff. So when this is breaking down on the hourly, it really gets my attention. The market is weak, and if this is breaking down, I don't try to take, like swing longs in the S&P, the Nasdaq, the Mag 7, none of that, because this is breaking down and this is weak. If this is bullish and holding its own, and the market wants to break out, then sure, it's possible it's a play. The last one here, the one that I covered up earlier in the talk, it has the ratio in it, but it also has the QQQ and the S&P in it. So that's what those other colors are. The blue one is the ratio that we're looking at. The S&P is orange, and then the Qs are this sort of a, I don't know, like a greenish cyan. I don't know what turquoise. I don't know what the color of that is. Not blue. Earlier this week, I believe it was Wednesday, I had pointed out that the ratio had started to break down, but the indexes had not. And I was willing to go short because of it. But by the end of the day, the ratio had actually turned back up. And so I canceled that call out and said, I don't want it now. I don't want to take my shorts. Huh. Someone's having an issue with a video. That should take care of it. So here we are finally getting the breakdown, and we can see that the S&P and the Nasdaq are joining in that breakdown. What's nice is a lot of times this will give us a heads up, and what I try to focus on if we get a breakdown signal in this thing is which one I want to short. Do I want to short the S&P? Do I want to short the Nasdaq? Lately, that's been a pretty simple question to answer. The Nasdaq has been exceeding the S&P, and so it generally has farther to fall, and or it has more room to run. This is just the 10-2 spread. We've been flattened out here on the daily for a while. Um, they use weird language when evaluating um, yield curve charts. So if you're not familiar with it, it's frustrating. They call them things like bull steepeners, um, bear flatteners, and it's just really frustrating language. But that's what they use. So if you run across headlines like that, or hear it in the news, at least you'll understand what they're talking about. Bull steepener is nothing more than it's going up. right? But why they can't just say it's bullish or it's bearish or it's flat, I don't know. The only thing I can think of is that it's been around longer and that it uses antiquated words or antiquated language, and it just didn't get cleaned up over the years. But whatever. We're still well above 1.0, and in this fade, we're still not expecting it to get below zero point 0.4. And as long as we're holding above that level, the market in the general backdrop should be fine. The expectation is maybe we come down and tag that level, we dance around it a little bit, but we don't break it and get lower from there. If we do, we really want to focus on the bigger picture market backdrop. Things could get bad from there. But we're not even there yet. And we don't know, are we even going to get there? If we do, we expect the bounce, right? We could overshoot a little bit, get into this 0.38, but we still expect the bounce. So it's fine. And on the move up on the year, we're not expecting to break 1.0 on the year, somewhere around like 0.55 first. Let's get there. And for the end of the year, nothing more than 0.65 at most. That would be extreme. We don't want to get there very fast either, right? No fast moves in this thing. It freak people out. This is my VIX tools. Well, it's not mine. This is a popular VIX tool. You can really spot backwardation and contango in this. I kind of went through that earlier this morning in the stream, but basically things in the front should not be more expensive than things in the back. So if you look at next year's mortgage cost, you have to project that higher because you just don't know, right? It's so far out in time. If you look at next year's options, they're more expensive because they got more theta in them. Anything that's farther out in time should be more expensive. So if you look out in time and things are cheaper than where they currently are, then that's what we call backwardation. If things out in time actually are more expensive and the things that are up front are really cheap, then we're just in a normal backdrop, and that's called contango, right? So the curve would look like this in contango, and it'll look like that in backwardation. The chart that we're looking at doesn't look like that at all, because instead it's more of like a RSI kind of oscillator. And for us, 0 and 120 are the levels that we want to watch. When we come up from below, that's bullish into the 120 area. And if we come down from above 120, that's bearish, and we would look to get into the 100 area. We're not supposed to get way down here into these extremes, but we've been in those extremes lately because it's been that kind of market lately. When we're below 0, we say that we're in backwardation. And as long as we're above the 1.0, then we're in contango. Right now, we're still in contango. But you can see the violence. We are starting to break down, and we broke 1.8. And that means you don't want to be long in the Mag 7 because we broke that. We broke that 1.8. If you are in the Mag 7, then you'd want to reduce your position size and start looking for exits if you can, right? That'd be the kind of backdrop. Now, this is a swing trade concept because we're on a daily time frame. We're looking at it on a big picture. We wouldn't use this to try to intraday trade or manage trades today based solely on what we think the market's going to do today. We're talking about earnings for options trades for like July expiration. You'd want to start managing them at this point, looking for exits. This thing can get violent and change from a day-to-day basis. You can see, we've got some examples here back in like December when it got really violent. We were down and up in a day. So that kind of silliness does happen, but generally speaking, it's more of a calm indicator, and it doesn't generally behave that way. And we can put it on a smaller time frame, but that doesn't really help, right? Especially if you're using it on that big picture. You can see how, that kind of shenanigans happened yesterday. And so this is telling you if you're long the Mag 7, reduce your position size. Don't look for new Mag 7 trades. And if we jump back for a moment to here, this is also telling you that your Mag 7 trades are in at risk, right? Because it looks like we're getting close to breaking that 2.13. If we have both of those, if we break the 2.13 and we have that indicator coming down from the 1.2 area, then it's two different signals saying watch out for your Mag 7 plays. It's like we want confluence when we can get it. This is just a picture of the bonds, different ones. I got the 2, the 10, the 20, the 5. So I just evaluate them. I'm looking for outliers or big moves. Really, I just pop in, I see where we're at. Are we near the lows, near the highs, anything of a trend? I really don't try to zoom in on these and read them from a day-to-day value. And if there's any big gaps, those stand out. I tend to pay attention. So I've had people who try to ask a lot of questions about this, like, what are you looking for? What do I do with it? Blah, blah, blah. Just keep it simple. Do you have a big gap? Nope. Okay. Are we hitting the high? No. The lows? No. You really don't have nothing to worry about. Move on. Look at something else. If you try to nerd out on these things and hold them to specific levels and then try to correlate that into S&P values and Nasdaq values, it can get really complicated. The same thing with trying to figure out, okay, if this is red, what should the S&P do? Should it be red too, or should it be green? Sometimes, yeah, and then sometimes no. And then, well, that's just confusing as hell. How's that helpful? So don't let it confuse you like that. Just stick to the simple stuff. It works. There's nothing wrong with it. We're not at the high right now. We're not at the lows right now. And we got that gap closed. So we don't even have a gap to worry about. We're good. Let it be. What's the market doing? Ah, see, we kept it. That's why the 111 is so good. Why we call it liquidity zone. What happened? We came back in again. That's why we marked the 111. I like it. Well, the good thing is we don't have to keep poking around over there. We are above the one. We need to keep it, and that means we need to get to that 786. Once we get there, we'll see. But it's already 3 o'clock. We're running out of time. So, it needs to, what do they say? Poop or get off the pot. Do it. All right, all right, all right. It's a very noisy chart. I didn't make this chart, but I found it a couple of I found it last year. I was going to say a couple of years, but it wasn't that long ago. I found this last year. Somebody made it, and I copied it and I kept it. So that's one of the neat things about TradingView. If you go to Google and you try Googling things, if somebody has wrote an article or published a chart, you can find it. Someone made this, and I thought it was fantastic. I call this the pretty one. This is the civilian unemployment rate, Bureau of Labor Statistics. And then down below, it's got a connection with gold and silver and miners. So I don't hang out here very often, right? Because it's a big picture monthly chart, and, but uh, you can see their annotations calling for this to be like a rounded bottom. And as I said, I got this, a while back. It's been there. I don't know how long that drawing has been there, but for a while. And we are working our way out of this and pointed to the upside. Now, the problem is we are also looking at the unemployment level rising, and it is continuing to rise. There's someone much smarter than me that has a level that they focus on with the not this unemployment number, because we got a bunch of different unemployment numbers, but the one that we just got the other day, the 243. Well, they say when we hit 267 I- or 262, one or the other, that's it. We're done. And we're going to see some crazy shenanigans happen in the market at that point. We're not there yet, right? But we are continuing to climb to the upside. Even this chart shows that. Yeah, I can share it. Like I said, I found it too, right? I didn't make it. I'm more than happy to share it. Just for a tip, for the most part, I won't show you guys something that I won't share with you, unless it's one of those paid indicators that I ended up with at some point. I don't buy indicators, but sometimes I get them. I can't share those, right? Because they will go after people who try to give away their indicators, and I don't want to get sued. So I can't share those. But anything else you see, if I'm showing it, that means I'm willing to share it. All right, TDEX. I spotted this the other day, but I wanted to wait for the stream. Let's start with the bottom. Y'all know what the VIX is. Yeah, it's just the VIX, and we're above 21. The line in the sand for the VIX is 19. Right? We can get nerdy and say 1911 or 1929, but let's just keep it simple. 19. So that's the bottom. Let's focus on the top now. TDEX. The TDEX is the normalized price of the out of the money put options on the S&P. So it's basically just asking, hey, are the price of the puts on average getting more expensive, generally speaking? And we can see that, yes, they are. Now, why is that different than the VIX? Well, the VIX is more about traded volume. Are they trading more puts than calls? That's what the VIX is looking at. This is asking about what's the price of those puts? Are they paying up for them? Yes, they are. So we're not seeing a significant increase yet, but you see that increase that we did have right here. Not only is it going up, they're paying up for it. And it's because they're paying up for it that the price is getting higher even faster. The more they pile into those puts, the faster they pile into those puts, the faster that price is going to rise. The TDEX will get extreme quickly, as you can see, like it did back here, right? Even in this narrow point in time, let's see if I can hold that in place. Yes, love trading view. Even in this narrow point back here, we can see how the TDEX shot up really fast and the VIX really didn't accelerate all that much at that point, right? But it didn't take long before they started to the TDEX really outran the VIX. So in the current backdrop where we are right now, get that out of the way. The TDEX is rising. Now those yellow lines are just lines that I've added over time for kind of like a line in the sand, and we are crossing my line in the sand. A rising TDEX suggests a growing concern about a potential crash as the cost of protection is increasing and they are continuing to buy it anyways. You know that they are penny pinching fools, right? They will not spend that money for nothing. So this is a bit of an alarming backdrop. If you are long in the S&P, the Nasdaq, the Mag 7, this is telling you to tighten up your longs, take some profit off the table. It's not telling you to get out of everything. but reduce your risk, reduce your longs. And we've had fake outs where this thing gets high and then it just fades back out again. The market got a little scared and we worked through it. So it's not a crash indicator. It's just showing you that the market is scared and they're putting money on the table. I like this because on MSNBC or one of those sort of shows, they can come out and they can say whatever they want. Go long gold, go this, go that. But they're just talking their book. They're trying to steer you in a direction that will benefit them. I say, look at what they're doing, not what they're saying. And that's what this is telling us, what they're doing. All right, the rising RSI on a 14 month above 60, and we got 14. We're on the monthly, and we are right at 60. So if we're looking for recession confirmations, we're missing it by a whisker. So I just had a good question. The question was, does the rising TDEX um, let me read the right question. Sorry. The current TDEX is right at the yellow line. Do you think it will find resistance there? So that's a good question. My answer is I I drew that line and I put it there more as a line in the sand that I don't want to see us get above and close above rather than as a level of support and resistance. And so at that point, I'd rather not see us close above that level, right? Because if we read the notes that I have here, we can really kind of get the backdrop of that idea. So I'm just going to copy these and put them in the chat. Still, that was a really good question. And for the recessionary issue, man, couple of things about this little post here about this recession confirmation thing. When you use a chart like this, where it closes is important. This month is like half done, right? Maybe if we're being generous. We don't have a monthly close. So this RSI, even if it gets above 60 on Monday, wouldn't necessarily count because it's not the end of the month. We didn't close above 60 at the end of the month. And the reason I say that is this thing can get really wicky. Um, let's go back to this one for a moment. If we look at this this April 7 low, you guys remember April 7? It's when they said that the Liberation Day tariffs were canceled or whatever, and he kind of backed away, and the market ripped back up. We'll go back a little bit farther to April 2nd. And if we look at April 2nd, it was all the way up here, 1.0, 0.98. Now let's go into the intraday. That's June. We're not even close. That's March, April. It went all the way down into the 60s, right? You didn't see 60 anywhere on that daily that we were just looking at. But here's the 7th, and it was in the 60s. And here's the second, well, the fourth, and it was down into the 60s. The intraday got really wild. But at the end of the day, on that daily, we never saw it, right? Let's go back to the daily. We didn't see those 60 levels, right? They were in the 80s, not the 60s. So if we go up to this current chart and we're looking at the RSI and we say, oh, it's at 59 and a half, and we're going to have a recession in 60, we can get to 60 Monday. That won't say that we're in recession unless we close above it at the end of the month. Yeah. But we're really close. So let's see how the new month's numbers are, which, by the way, since this top level gets updated every month, we have to wait for the new numbers to come in. And that won't be July 1, right? It'll be like July 8 or something when we finally get them. All right. It's a quarter after, and I bet we're not going to have any more issues. So I'm going to go ahead and turn off some of this jigsaw stuff. You can see the cumulative delta just kept melting down, even though we're running back up. But we're getting out of things. We're ending the day in front of a short week. It's not a surprise to see cumulative delta acting that way as we near the end of the day. I didn't save it. I should have, but whatever. This one's really simple. Do we have a liquidity issue? It's still rising. We don't. It's short and sweet. It's more of a Federal Reserve net liquidity. So short and sweet. No, we don't. Didn't hurt to peak. All right. Now this one is on a lot of platforms. Thinkorswim, TradingView, a lot of them have this. How many stocks are above the pick a moving average? How many stocks are above the 200-day, the 150-day, the 100-day, the 50-day, 20-day, 10-day, blah, blah, blah. The smaller the moving average, usually the higher the number of stocks. I've seen this used for years by different people. Stockcharts.com, they're big fans of this. Generally speaking, pick a moving average that you like on a daily and use that one. 200 is a really common one that I like because it's just a big picture number. I don't know why I set this one at 150. Probably just what I ended it on the last time I used it. But you can save those. I've got watch lists that are made of all of the different moving averages, and then you can just jump into whatever one you want. I'd have to find it, but they're not crazy expensive, right? These are like old school market breadth indicators, basically. And for me, I like to use the 100s. So S&P 100, NASDAQ 100, rather than using something like the full NASDAQ with like 2,100 or 2,200 stocks. And I don't like using the Russell one if you can even find it. That one's hard. With 100 names, if you have 60 names out of 100 above say the 50 period moving average, then you can say 60% of the market. Right? You can turn it into a percentage very easy. So I like using the S&P 100 or the Nasdaq 100. If you want to search for it, just start with S, right? That'll get you pointed in the right direction. It's like S1 because it's S&P 100 of, and then whatever your moving average is. I know I've got a list of these somewhere. Dig around in my watch list. It's probably the breadth level. Inflation, yields, volatility, total market. Yeah, there it is. So here's the stocks above the 5-day, above the 20-day. You get the idea, right? Now these are the S&P 500 instead of the S&P 100. But there's your 50, and there's your 200, and then there's your Nasdaq. So we're really focused on like overbought and oversold levels. The market, I don't know if you guys have heard the phrase. It's not really new, but they'll say something like the market's getting overheated or overzealous. And that's what they're talking about. So if you have 100 stocks and 90 out of 100 are all above their 50 period moving average, you're getting into the extremes. You're getting really close to like a blow off top or a market that's getting so overheated that you're due for a correction. Back in the day, they talked about the shoe shine guy on Wall Street giving out stock tips, right? Like if your grocery bagger is, talking stocks while he's bagging your groceries, that every Joe Schmo on the street corner is talking about buying stocks, you're looking at an overblown market and just getting ready to correct. It's just, everybody and their cousin's uncle is all piling into the market. It's time to think about going the other direction. And it's not a perfect signal either. We got that signal here. If I just stop my mouse and it lined up right here. And sure, we went sideways for the whole month of December in that, right? Then we got into the new year and away it went, ripping to the upside, but not with the broader market, only with the Mag 7. If you guys remember how 2024 started out, the Mag 7 was doing all the work and the rest of the market was not. And that's what this was really highlighting. So, yeah, you can get in the weeds with it, kind of get wonky, turn into a little bit of a nerd. Look at where we are right now. And it's not the Mag 7, right? It's connected to the Mag 7. Got these hyperscalers spending all that money, and you've got drones and SMRs and robotics, UFO, telecommunications, uh, space companies, satellites, and just your general broader market backdrop. So we are getting into that extreme level. Kind of got to be worried about. But we're only at 80. We were at 80, almost 85. We pulled back a level. We're not into that 90 percentile yet, but we're getting there. And look at how swift we got there, by the way. We were really low at like 8 and 6 and 5. And in a month and a half, we were sitting in the 70s. Now we're kind of digesting it a bit more. This is a generic image of a liquidity. Again, it's like Bank of America high yield. We just call them credit spreads. That's good enough. And when it's spiking high, we've got a credit issue, we got a liquidity issue, and we expect the markets to really have problems. But you can see how we're off the highs. Sure, we're turned up a little bit and we're still above the trend line, but we've come a long ways off of those highs. And right now, this is not an issue. I would think we're starting to get an issue if we break this high here, this 3.4. So until then, in the broader backdrop, we're fine. It's fine. Well, I was looking for market breadth and issues with breadth, but we don't have any. So no issues on that one. See what else we got. So far, we've had some issues with the Mag 7. That's been a tell, but nothing that says we should, get heavy, get short. Yeah. Everything that I've come across so far says just reduce your longs, reduce your risk. Right now, this one's a real popular one. I'll show you my version, but we'll look at theirs first. This is the weighted versus the unweighted version of the S&P, right? They're both the S&P, just one doesn't have that weight. And the reason for this is the Mag 7 group can really bully the rest of the market around and it influences the S&P. Duh. So what we want to do is remove their weight from the market and just look at everything on an equal weighted footing. And when we do that, we can see that in pink is the S&P and in blue is the unweighted S&P. The Mag 7 are the reason that we had that run back up, right? Otherwise, we wouldn't have had that run back up. We can see the broader market heading to the downside. If this was going the other way around, look, excuse me, hold on. I said that wrong. Back up, back up, back up. I forgot the way I had this chart built. In blue is not the unweighted. In blue is the ratio between weighted and unweighted. So let's turn the S&P off first and just look at this. When you got a ratio, you got two names. The first name is the boss. So if this is pointing up, RSP is in control. If this is pointing down, then the second name is in control, SPY. So when it's pointing down, that tells us SPY is in control. That the weighted names, like the Mag 7, are overpowering the unweighted names. And it's not to say that the unweighted aren't going up. Just when we talk about outperformance, the Mag 7 is outperforming everybody else, and that's why this is pointed down. If it was pointed up like we had at the beginning of the year, this was telling us that the Mag 7 was taking a break and that if the S&P was going to rise, it would be because of the broader market and not because of the Mag 7. Same thing here with that really strong drive into April. right into those highs of April. No help from the Mag 7. Now let's turn on the purple line, the pink line. That's the SPY, and it was being held up by the broader market. So this move in SPY with this move here in the ratios, that was the broader market carrying things. Then the Mag 7 got involved, but we didn't go anywhere. And the Mag 7 gave up and this started to rise again and the S&P started to fall. Because we didn't have the Mag 7 helping us, the broader market didn't step in to take over and we fell. We continued to fall. Now we've got the Mag 7 participating and we've got the S&P rising. Imagine that, right? The hyperscalers doing all the dirty work. This says they're not done. Even with this sell-off that we had today, you can see how it's pointed down. So is this. This says that the hyperscalers are still outperforming the broader market. All right, I mean that's useful, I guess, especially from the point of view that we just saw that we've got an issue with the Mag 7 about to take a break. If this breaks and closes below 2.13, we're going to expect those hyperscalers, the Mag 7, to call a timeout. Well, that's going to suck because they're the ones doing all the work. Same thing here. This is driving to the downside. If this gets below that, well, actually, it doesn't even have to get below. It has crossed under 1.18. That says lighten up on the Mag 7 because they're likely to take a break. That's two different indicators saying be careful of the Mag 7. And now we have this showing that they're doing all the work. So if they take a break, we could get a pretty decent sell-off or at least get a decent pause like we did back here. We didn't crash and burn, right? We just quit going anywhere. And here, once we did get down to those levels, we just stayed there for a while, not doing anything. Same thing. So we don't have to crash and burn, but it's, you know what it's telling us? Don't buy the new highs, the 6,100 level. Not happening, right? Or SPY 700 or whatever. Not happening. So that's the popular version of the ratio. I use a different version because while that one's cool, we all know that the Mag 7 really ties into the NASDAQ and that, the tech is the boss. So I went hunting for the weighted versus unweighted version of the QQQ. Same idea, right? Only instead of it being the S&P, it's the Qs. So I'm going to turn the Qs off. We'll just look at the ratio. Get my little notes out of the way. And you can see how clearly that change into 2025. I mean, just that was beautiful, right? When this is going up, the unweighted is in control or is outperforming the Mag 7. And when it's going down, the Mag 7 is in control, basically, right? So we can see the unweighted has been taking a back seat, and the Mag 7 has really been dominant since the 1st of April. Well, that's odd, right? Because what happened in the 1st of April? Liberation Day, right? April 2nd, he gave the announcement, blah, blah, blah. And we had that steep sell off in the market. And then he capitulated and the market popped back up. And we've been going up since. Not in this. This says that the Qs have been dominant in that rise back up, not the general broader market. They keep saying that the tariffs are going to hurt the broader general market. Look at that run up in the Qs done by the Mag 7 by the hyperscalers. So now we know. Yeah. We are headed down today in the market, and we are still headed down in this. That's not going to help, right? They can both fall, they can both rise. But generally speaking, if I zoom out, you can see how it goes. In the bigger picture, generally you got one falling and one rising, or you have one rising and the other falling, like we had here when they were pinching together. This indicator rose swiftly up at the first of the year, and the markets were falling in the first of the year. They almost got a pinching pattern. We were falling here, we were rising here. So when it changes direction, we start falling here, start rising here, and that's not done. It's still doing that. If they both fall or they both rise, it'll be for short periods of time. This is one you guys can use to intraday trade with. It's pretty useful for that sometimes. And the reason I say sometimes is, we always have to ask, what's making the market move today? So on the left is the US 30 JP 30. Remember, we talked about that earlier back here with this ratio. In the middle is the buy right monthly index. That's a really handy tool for anybody that doesn't have Spot Gamma, Mentor Q, um, Volland, one of those guys, right? One of those expensive dealer gamma hedging optionality tools. If you don't have anything like that, just use the buy right monthly index. It's free. Go to your charts and just look for the BXM. It's the buy right monthly index. So what this is telling us, when it's going down, puts are being bought, and if it's going up, calls are being bought. Just keep it as simple as that. It's not that simple, but just think of it as that simple. So if the S&P is falling and this is falling and the ratio is falling, you're good. Go short. But if you're looking at this and you start to get a discrepancy between the three, you want to find out which one is in control, because it'll start to change, or you'll get a leader, right? That one will break down first, like right now. It looks like buy right's leading, right? Because it's red, but it's not. The ratio was already in the lower part of this zone and looked like it wanted to test the lows. This isn't even at the lows. It's not even in the middle of the range yet. And the S&P was almost at the lows, just like this was almost at the lows. So we can see that the intraday options are not driving the bus, right? And if they are, they're trying to drive us back to the upside, and they're having a hard time doing it. The 0-day crowd, so to speak. And that would make sense because there's only 20 minutes left. What's the 0-day crowd going to do? Try to run in and buy calls at the end of the day in front of a short weekend? I don't think so, right? So this buying that we see is more likely them exiting their any kind of upside trades that they were in, right? Or that they're exiting their shorts. Because if you're buying them back to close your shorts, that's going to give us a pump up in the buy right monthly index. But that wouldn't tell us to go long. That just means they're closing their shorts. So during the day, this can be a really handy tool. The problem is that the buy right monthly index does not work in the Globex hours. So when the market opens, then it's useful. With that being the case, a lot of times I'll put the SPX over here on the far right instead of the ES. And that way the SPX and the buy right monthly index are both showing the same time frames, right? Because there's no Globex on either one of those. And then the outlier is the US 30. And you can just, change the chart settings to hide Globex on that one. And then they all three start at the same period in time. And it just makes it easier to chart. When we get outliers here, it really stands out. So from a day trading point of view, it's not always handy, but that's anything. tick charts, weighted AD, advanced decline ratios. Sometimes they're helpful, sometimes they're not. So when they're not, just turn it off. Who cares? Go look at something else. Look at it how divergent it is right now. S&P trying to rise. The ratio trying to rise. The buy right monthly, it's falling. So one of these is wrong and it's warning you, hey, be careful. This run to the upside doesn't look good. It's getting shorted in the options market. Yeah, just let me hit the button. There you go. I put that one in the chat. All right, so this chart, um, there we go. You really want to leave it on the higher time frames. I know that these market symbols seem very weird, right? But it's basically a gold versus silver ratio. And collectively, gold with silver, basically. This is one of the most bullish backdrops we've ever seen in gold and silver. I mean, look at this. Sure, back in '08, look at that run, right? For like 2.5 years. It was just a ripper. And then gold and silver has been junk for years and years. And now we're back, baby. And it's been a heck of a run, right? 2020, 2022, we got to the top of the range and then away we went. And it's still going. So when you're looking at gold and silver and you're thinking, my gosh, it's run so high. Maybe it's too late. I missed the run. You ain't missed nothing yet. It's still going. And all those little bitty gold miners and silver miners, we talked about this months ago. And I told you then, you'll know it's not done because even the worst performing, the crappiest miners out there that nobody would touch with a 10-foot pole are going to start to get bought. And what are you seeing now? Some of the sorriest miners, penny stocks, they're getting bought. And they're more than just little pops. They're sustained. They're being driven. It's not done yet. And that's what this ratio chart is really good for. But it's a big picture point of view, right? You can't use this from day trades, that sort of stuff. It's just not going to help. It's just big picture. Are we done yet? Nope. So that's a real handy chart in the backdrop, right? We are not done with gold and silver. That's the takeaway. All right. Now, this one is my own creation and it's a work in progress. Feedback would be good on what you guys think of it and what you think we can do to improve it. First, I'm going to turn off the S&P and just look at the ratio for a moment. What we're looking at is this ETF called Top T. I kind of like it. It's the top 20 names in the queues or in the market. And that ETF all by itself, pretty awesome. It's the top 20 names, right? Sounds great. And it is too. I mean, you just open that up and just trade those 20 names. For a long time, I had my own watch list that constantly monitored the top weighted names in the S&P or the Nasdaq. This takes that work out of your hands so you don't have to do that every day and just look at that one ETF, which is cool. The other ETF here is the Mag 7, MAGS, which is also kind of new. It's not new to us. We've been making it for years, right? But now you don't have to. You can just look at the Mag 7 in the ETF that they provide. So I got to thinking, if we can put the weighted versus unweighted, we looked at those, remember? If we can do it that way with 100 names, why can't we do it this way with much shorter names, much shorter list? 20 names in one and like 8 names in the other, right? So I talked to ChatGPT about this. My concern was the number of names in each would break the ratio and it wouldn't be fair. But after a bunch of whole lot of nerdy talk, it basically said, just try it and see what you get. Right. Well, thanks. I was going to do that anyways. So here we are, and we have this ratio. The the first name is the Mag 7. One piece of feedback that I've gotten already is that we usually go weighted, unweighted, which means we should have the Mag 7 in the back, not the front. That way, if I bring up that weighted versus unweighted from earlier, when the Mag 7 was dominant, the chart would fall. In this one, if the Mag 7 is dominant, the chart would rise. So it's actually going in the wrong direction compared to what those other charts were doing. And I like that feedback. I just haven't done it yet. Then the other bit, um, and one of the reasons I haven't is because in the other ones that we were looking at, if the Mag 7 is dominant and the ratio is falling, the S&P or the Nasdaq is rising, and they always went against each other, right? One would be going like this, one would be going like this, and that just confuses the hell out of people. When I built this, I thought, well, hey, let's make it go down if the Mag 7 is not in control. And well, what do you think happens when the Mag 7 isn't in control? The S&P goes down or the Nasdaq goes down. They're both moving in the same direction. That's why I went this way. So I liked that feedback. I just haven't done anything with it. Second, let's put it out on a daily. This is the Mag 7, and you can see I did mention they're new. It doesn't go back very far. And think about what has happened this year. We got into 2025 and the market really hasn't done much, and not that anybody's been happy with, anyways, until the April lows when the president capitulated and started backing away from all the tariff talk, and the market's been trying to rally since then. We had a nice bump up, and now we're kind of stalled out. The Mag 7 started to take control and outperform the broader market, and now we're kind of stuck. It's not doing much better than the top 20 names. To me, I find that really insightful because the top 20 names are there for a reason, right? They don't necessarily have to be the hyperscalers. So if they're working in sync, this will stay sideways. It won't have big moves down and it won't have big moves up. It'll just be doing this sideways thing because they're not outperforming, they're just working together. Then, if the Mag 7 drops the ball and doesn't lift its own weight, will fade off. And if they get out of control and overheated, will rise up. I kind of like it. So it's a work in progress. I uh, I think a lot of these new tools that we have, we're not even barely scratching the surface of what we can do with them, and that's why I try to come up with new things. So we compare that to the S&P, which is this pink line here, and you can see how we stalled out in the ratio. We ran up and the market ran up, and then this thing stalled. The market went a little bit more and then it stalled. Even that breakout that we had wasn't matched here. So lower highs in my indicator, higher highs in the market. Maybe maybe it's a warning or a heads up. I don't know what I would do with that yet because it's still so new and we got to grow into it. But still, I decided I'd show it because this isn't the only new ETF out there. There's a lot of new things out there, and these single stock ETFs are really cool. But I don't think we're using them very well yet either. You guys should experiment, try different things, see what you can come up with. You never know, right? You might find the next crazy, amazing ratio that we'll all be using in 2 or 3 years from now. This is another one of my own homemade ETFs. Turn the S&P off here for a moment. We're looking at the 9-day VIX versus the 1-day VIX. This is more about backwardation levels and contango and that sort of stuff. But the 1-day VIX sometimes gets really frisky really fast, right? It's a short duration VIX. So when the 9-day is in control, this thing goes down, which is what we see here, right? It goes down. When it's headed to the upside, when that 1-day does get into control, we see these elevated moves up and even into the intraday, like right here, it was still headed up. Let's go to that particular day. That was May 20, and we're looking for a market reversal around 10:30 in the morning on May 20. May 20, right there. Yeah, I mean, it's a pretty choppy day. Hey, but have a good weekend. I hope you get a lot done on that deck. How far are you guys away from getting your project finished? Nice. Well, it sounds good. Yes, sir. Have a good weekend. So you can see where like this thing sold off. The S&P was unable to get anywhere. We just went sideways all day. But this kind of discrepancy, I don't know what to do with, right? It sold off, but the S&P rallied anyways. But it's something I put together. I've been watching, I've been trying to figure out ways to use it and or what to do to adjust it. But those short-term VIX, they are kind of new in the grand scheme of things. And I just think that we can do more with them. I don't know exactly how yet, but I'm always experimenting, trying new things. Don't be afraid to try, right? Because the worst that happens is you burn a little bit of time, but you don't get anything out of it. Yeah, we already know that one. That one not new. Uh-oh. I must have broke it. This is the volatility of interest rates, but something's wrong with it. I'll have to figure out what's wrong. The main takeaway, guys, is that with all this hype out there of how bad everything is, most of the things that we saw today did not say that things were bad. Sure, there's risk, right? And the Mag 7 is slowing down, it's getting a bit exhausted, but for the most part, we didn't see serious signs of failure in these tools. We mostly saw that we're getting a little soft or we're topping out, that sort of thing, like reduce risk and, kind of lighten your load. But nothing out there in all of these tools said short the market or get heavy short or anything like that. Those talking heads, they're just chipping their teeth trying to talk their book. And I'm not loading up with shorts, not at all. There's nothing wrong with some hedges. If you can get some shorts on really cheap, why not? Right? Like, why not carry some? But if you're looking for, some signal that says everything's going to crash and burn, we got nothing. And there are warnings, like when COVID was sneaking up on us, there were signals. So, if it's bad, we would start to see it. And it doesn't mean that headlines can't catch us because, headlines are headlines. You can't see them coming. That can always happen. But we're not seeing somebody in the know adjusting serious money ahead of time. The cumulative volume index starting to roll over, but that's not new anyways, right? We're rolling over with the market rolling over. So not a big deal. And it's not divergent like it was, like back here, it was really divergent, or here where we topped out, not the market, it just kept going. So we don't have that sort of divergence. One more and we'll call it quits. Because it's a really good one. There it is. This is another one of those that I do on the monthly, but it's worth it, right? So what we're looking for on this monthly candles, think of this as your tech gauge or Mag 7 gauge. I like to think of it more broadly as tech and not the Mag 7. Green bars and holding support, moving to the upside. It says the broader market is solid. We're going to maintain and just continue to perform well. If it flips over and it's red bars and we're falling down and we're breaking support levels, then the broader market's going to have some serious problems. And we can see that, like when we broke out and we got overheated and was really running into the 2022 bear market, and it fell all year through that 2022 bear market to the lower end of the platform. We broke the lows, peaked outside, and then we came back in, kind of stalled. We've been holding the middle of the line and we're starting to broaden out into a megaphone pattern, but we're still green candles. And look at that gap. Monthly gaps, guys, they're crazy bullish. That's a big bullish gap. And the bar made after the gap was as big as the bar made before the gap. And we closed near the high of it, or at least in the upper half. And we're still in that upper half. So, right now we need to break out of this and go higher. We're not even looking at any concern unless we break this bar's low and this bar turns red. Then we would be starting to have some concern, but we don't have that yet, right? And if we do turn this bar red and break that level, then we want to focus on the midpoint of this bar, which is about where those moving averages are. Break that mid, and then, we'll focus on the low of the bar. And then we get to that. We'll try to get the gap closed, on and on and on, right? Level by level by level. We don't have any of that yet. This is a big picture tool, but it's still not saying that we're overbought, we're overextended, we're overheated. It's not saying any of that. I don't see any reason to get short the market. So hopefully this really helped you guys out. And we did do the cumulative delta in the front part. So you can always catch the replay, check that out. If you guys got questions, hit me up. If you have topic requests, I'd love to hear it. And otherwise, I'd say let's wrap it up and get the weekend started. Nothing? All right, guys. Enjoy your weekend. Remember, next week is a short week. We're going to be off on Thursday. We also have FOMC next week, and we have triple witching on Friday. And if you're trading options or futures, next Monday we will be rolled into the new contracts. They won't be expired. The current ones won't, but most people won't be using them, right? We'll be using the new contract series. So you can manually roll your futures up, or you can just let the platform do it, depending on what you use. All right, guys. Monday morning, I'll see you at the morning briefing.